Good morning and welcome to the Big O Money Show. Andrew Galvin here, my guest host, or I guess co-host, Tony Shore with me. Tony, how you doing this morning?
Well, I'm doing great, Andrew. Fantastic.
Good.
I've had a great week. In fact, last weekend I was in Nashville, down in Vegas.
Were you?
Yeah, I used to live there, and some of my friends threw a birthday party for me down there, and it was a lot of fun. My wife and I went down. Flew in Thursday. We're there Friday, Saturday, all day Sunday. That was fun. You've been to Nashville?
Yeah,
I know
went
that.
one time with Gradient.
Yeah. Yeah. In fact, you were getting, I think, engaged that weekend.
I proposed to Andrea in a small little park in the middle of Nashville that we just found randomly driving around. So
that is amazing.
It makes me seem like I really put a lot of thought into it, right?
Well, you had something all planned, but the weather and other circumstances I remember the story, derailed your plans a bit.
Yeah.
But we're not talking about that today. That's a great story, though. We have a lot to talk about today. I mean, there's a lot going on out there, especially with the finances. And, you and I, we watch what's going on in the financial news, and we talk to financial people every day, all day, financial advisors. So we understand the industry speak, but when you told me the title for today's show, are financial advisors speaking another language? I think they are, with words like arbitrage and dollar cost averaging, sequence of returns. What does that, rollovers, what does that mean exactly? Right?
Yeah. And it's funny because, as I was thinking about what we were going to do for this week's show, Tony, I actually polled some people and I said, have you ever heard this concept? And, what do you think about when somebody says diversification? What do you think about when somebody says, a rollover or a distribution, or, you talked about sequence of returns risk,
right?
Or like the 60-40 split. People hear that and they don't
rule of 100. Yeah.
So, but before we jump into that, Tony, I did want to say first and foremost, happy Easter to you and all of our listeners. It's Easter Sunday today when the show goes on air. So to those that are getting ready to go to church as they're listening to us this morning, hopefully you're going to enjoy your Easter service and spend some time with your family. And Tony, hopefully you are as well. And
oh yeah, definitely.
Yeah.
All the kids and their significant others are getting together, and we're going to go down and see my parents. So I'm excited for that. Today is Easter Sunday, as you said, when the show airs, and I too want to wish everybody a happy Easter. And I'll never forget, I was traveling with a gospel group, actually a Christian music group. And so we go to different churches, but we were in this one church, and this pastor, it was like the Palm Sunday or a service right before Easter. And he's talking about the Easter message, and he got really worked up and he said, Easter's not all about the bunny, So now whenever I see those guys that I was with, I'm like, it's not all about the bunny, It's not just about the bunny, I think that's what he said. So remember, folks listening out there, it's not just about the bunny.
Yeah, it's not about the chocolates, it's not about the eggs.
Right.
There's a much higher purpose involved here. So.
Yes, that was his point. But the way he said it, it's not just all about the bunny, He was really like almost yelling,
wagging his finger at him.
Yeah. He was shaking his finger at the crowd. And I'm like, oh, yeah. Well, the kids were all away for the children's service or something, so I think that was okay. He wasn't, just we'd have crying children.
Yeah, we love the Easter bunny.
Yeah. So it is Easter. Glad you mentioned that. There's a lot, but speaking of Easter and giving and caring, and gifts, Easter is really about a gift for all of us. But I know that Bill Altman and the rest of the team there, yourself, Andrew, and Bill Kaiser, and everyone there, you like to give back to the community.
That's right.
And the Premier Advisory team, you got a great team there, but you really care about the community, and it really comes across from you and Bill and what you say. And you love helping the community, not only people in the community with their finances, but reaching out. And there's a really good cause that you're a part of.
Yeah. Yeah. So we're actually going to be doing a day without shoes. And that's, we partner with Cornhusker Bank, and they bring a tote into, I guess more than a tote. It's a giant box basically that we put in our entryway, and then individuals can drop off shoes, whether they're new, slightly used. Obviously, if they have holes in the soles, maybe don't bring those into us.
Yeah, if they're too beat up, no. These are shoes that need to go to people and families that can't afford, good shoes. So we are looking for donations of really good shoes. You can bring new, you can bring slightly used.
And all shoes. It doesn't have to be like just tennis shoes. It can be dress shoes. It can
from cowboy boots to sandals. Bring them in.
Yep.
If they're in decent shape. Yeah.
And we're going to be collecting those from April 6th going all the way through to April 19th is the dates there. Yeah.
Okay.
And then all of those shoes at the end get donated to the Stevens Center here in Omaha. Basically, we allow their individuals to come in and pick out their shoes, and it's a really good cause. Cornhusker does it every single year. Bill told me, actually, funny enough, we were the first business in Omaha to partner with Cornhusker Bank on this shoe drive.
I remember when we had the people that run it from Cornhusker Bank on the program talking about it. He's had them on a couple of times, and they said that Premier Advisory Group was the first business to participate and really put their full support behind the program. And it really is helpful. I actually have family in Omaha who they know people who have been touched by this, program. My aunt and uncle know people that have been touched through this. So I think it's really important, and it starts tomorrow, Monday. So people are hearing this on Easter Sunday. Starting tomorrow, you can drop off your shoes at the Premier Advisory Group there, right on the corner of
119th and Stonegate, or 11910 Stonegate Drive. If you're on 120th going north towards Maple, we're just right there off of Stonegate. We're right across from Cox Communications, just down the street from Mulhall's. So
yeah, Mulhall's kind of in between Culver's and Mulhall's there. I love that.
Culver's has a great spicy chicken sandwich.
Ooh, let's not talk food right now. That's not. Speaking of eggs, how about that spicy chicken sandwich at Culver's? The shoe program is great. And again, what's the name of the organization?
So it's Day Without Shoes with Cornhusker.
Day Without Shoes.
Yep. And again, those dates going from April 6th to April 19th. So you have weeks there to come by, drop your shoes off right in the entryway here at the Premier Group, 11910 Stonegate Drive. So
and they can come in and say hi to a celebrity, Andrew Galvin, a celebrity star of screen and radio. Andrew Galvin, you yourself will say hi. They can say hi to Bill and the gang, drop off some shoes. And if you have questions about finances, drop off shoes and say, hey, I'd like to talk to somebody.
Yeah.
It's better if you set up an appointment for that, for a real thing. But
Yeah. And what's really funny about that too is, people do that, Tony. Like they come through the front doors. They don't make an appointment sometimes, and they just walk up to the front and they're like, "Hey, Justine, is Andrew available? I've got a question for him."
Because they heard you on the radio, or they heard about you. Your reputation precedes you, because you've helped. No, seriously, you've helped so many people. I mean, I know my cousin that tells, he's like, oh, Andrew's really helped me, and he tells his friends, and so people are like, oh, I got to talk to this Andrew Galvin guy. So for our listeners and viewers, it's better if you go online and make an appointment. There's still no cost or charge, but you guys get busy, especially different times of the year. You're busy usually all year round, but there are peak peak times as well. So somebody might not be available, but if you drop off shoes and do have a question, you ask, hey, who can I talk to? If Andrew's not available, somebody probably will be. And so, I know you guys don't turn people away, but it's better to make an appointment and then bring shoes with you. Make an appointment in the next to come in the next 2 weeks, whether it's tomorrow or the next day, and then bring a pair of shoes. Maybe you've got a pair of shoes you haven't worn in a while, and it's like, hey, these aren't too worn. I'll bring these in and just drop them off, because they will give a needy person who can't afford shoes. And I think that's fantastic.
Yeah. Yeah. So with that though, Tony, I know we kind of already teased it a little bit at the beginning, but let's dive into some of these things that we as financial advisors tell individuals, or they hear us say, and let's talk about what they really mean. Because I think we as financial advisors sometimes talk right by people. I mean, we say something and you get done telling somebody something in the office, and I always hear this. They're like, well, I'll go home and I'll think about it, and I won't really necessarily know what you said, because I don't, that term or that thing that you told me about, it doesn't necessarily mean anything to me, because
it doesn't resonate. And sometimes it's like, what does that really mean for me?
Yeah.
Right.
And so, not to say that we don't follow up with those clients and make sure they do.
Oh, sure.
But, it's really about breaking it down to plain English. And we financial advisors, we focus so much time and energy on becoming masters of our craft, right? On working on asset allocation, diversification, Monte Carlo simulations. You hear all these terms, right? But what does that actually do for an individual? So I've got like 2 or 3 terms here that I just kind of want to walk through today, Tony, and just kind of break down what we're talking about, right?
Right.
So let's start with stay the course, because that's very timely right now, right? The market's pulled back a little bit this year. You hear a lot of financial advisors saying, stay the course. And so a client comes in and they're like, well, yeah, but I'm losing money, right? I'm losing that.
Right.
Account value's going down. I got the statement in the mail. What are we doing to try and offset some of those losses?
Sure.
And the stay the course isn't necessarily something where we're not trying to rebalance if we feel it's a timely move to make, but we're not doing nothing. We're just telling you not to make an emotional decision about your finances at a point where you potentially might sell out at a loss. And then what happens then? You're going to sit there, you're going to blame us, you're going to regret it.
That's not good.
Things happen, right?
Yeah.
We don't want that.
Right.
So, we go back to the stay the course and go back to the plan, because the plan was built for times that there may be volatility, right? The market's not going to be all sunshine and rainbows all the time. And it'd be great if it was, but the market doesn't work that way, right, Tony?
Yeah, we've seen it recently, how absolutely volatile it's been.
Yeah. So, we want to avoid those emotional decisions.
Yeah.
That's what we're talking about when we say stay the course. Because if you call me freaking out, that's automatically a sign to me that we're not in the right frame of reference to be able to make a non-emotional decision about what's going on with the market.
Sure. But not that you're scolding anyone, and you shouldn't feel bad about that. We all have those feelings. I mean, even you, me, Bill, if we have money invested in the market or a retirement account, when the stock drops 10% or 20% like it did last April in 2025, that we all get emotional. It's human nature. It's going to happen. But the thing is don't act on it. And the worst thing you can do is panic and sell when the market's down, because then you're selling low.
Yeah.
And you're trying to time it. When do you get back in? Or I heard it's going to drop, or it looks like it's starting to drop. Even if it does, you can't try to time it, because you don't have to get it right once. You have to be spot on twice. You have to sell when it's high, and then it goes down, and then you have to get in before it starts going back up to get all the gains. So, and so your timing has to be right. Nobody has a crystal ball.
Yeah.
And the people who stay in do better. Every survey and study
They just
says that. It depends on your time horizon. So the money, and hopefully you won't need to pull money out while it's down, right?
Yep. Yeah. And so, that then leads into like the diversification piece or like the sequence of returns risk.
Right.
I hear a lot of people when we talk and do seminars, we often bring up sequence of returns risk.
And people get confused by that.
They get so confused by it.
Yeah.
But basically what it means in a nutshell is if we have a down market and you retire that year and start taking money out right away, how is that going to impact the long-term health of your retirement savings?
Right.
Because it's shown if you have back-to-back down years in the market and you're pulling money from your portfolio versus back-to-back up years in the market when you start pulling from your portfolio over 20 or 30 years, you end up in a very different place. And so your plan should be made to specifically address those issues at the outset so that hey, if I am going to retire and the market's down, I'm going to be okay with what happens because I am properly allocated and I'm properly diversified inside of my portfolio.
Right.
Yeah.
Yeah. And so a lot of people get confused by sequence of returns and they think, what does that mean?
Yep.
And so what it means is when you're pulling your money out makes a huge impact on how quickly your account depletes.
That's
It's
right.
not how much,
No.
It's not, I pulled too much out or I pulled too little out. It's when and in what sequence. And so a great example is if you're pulling money out of the market each month to live on and to pay all your expenses in retirement, and the market is down 2 of your first 3 years, your account's going to deplete much quicker than if it's up those years and it's down 2 of your last 3 years and you're pulling money out. It's going to affect the balance way more if it happens early on. So it really makes a difference. If you don't have money in there during certain periods of time, you're going to miss all the upside and the compounding interest. That's what sequence of returns means, right?
Yeah. And then you look at inside of the portfolio, is there some place that we can take from that's going to be a little bit more resistant to those volatile times in the market? Instead of taking from stocks, do we want to take from the bonds in your portfolio? Because we know that that's going to provide a hedge against that volatility.
Yeah.
Or do we want to live on savings for a little bit that we've got in the bank, that those funds don't fluctuate at all with the market?
Right.
And they're also not earning very much. So we can take from that while we wait for the market to recover. And that means that we still have the diversification within the portfolio. We're following the plan that was set up, but there's always these different buckets that you can draw from. So, that's one thing that I think when you hear the sequence of returns risk, Tony, I think it's really important to just remind people, we don't want the market to start going down as soon as you're drawing money from your portfolio. That's really what we're concerned about, right? In a nutshell. Yeah. That's all it means.
Yeah, there you go. And that's huge. You need a plan to successfully navigate this and need to be working with a financial advisor like yourself and the team there at the Premier Advisory Group. But that's how it happens. And you really want a plan in place to make sure you don't make those mistakes.
Right.
But I'm glad you explained sequence of returns. That's so important. Diversification. These are terms you need to understand. And it's not necessarily that they're that complex, but it can confuse people when you're throwing all these words out, that concepts they're not normally thinking about.
Right. And on that diversification topic too, when we're talking about diversification, we're talking about much more than, hey, I have 5 different tech stocks and that's my entire stock portfolio. I've got $1 million, 70% of it is in 5 tech stocks. Is that diversification? I mean, to me, it's not. Now, to that individual and their risk tolerance, they might be properly balanced. But if they come in and talk to me and they say, yeah, I'm kind of, I want to be maybe, a 60-40, and we've got 70% in the market versus 60, and then that 70% is only split between 5 different companies.
Right.
That's not true diversification.
Right.
That's diversification is looking at different sectors of the market, which tech is only one sector in the entire marketplace, right? And there's 5, 10, 15, however many different sectors there are. But if you're only exposed to the tech sector, well, then you're not really diversified.
No, you're not. And even if you say, well, I'm diversified because I'm in these 2 different funds or whatever, they could have the exact same stock, or you could just be doubling up. And that's a huge reason right there to set up a consultation, one of those no-cost consultations, because you guys can look and run a report, the Compass report, or a financial report that will show them, here's where your money's actually at. And here's the percentage that's in tech. And I think people are shocked when they see, oh, these are the stocks that my money's actually invested in within these accounts, and I'm doubling up all over the place, right? Do you see that happen?
Absolutely. I looked at somebody's retirement funds yesterday, actually, and they had sent me a statement. They're in a growth fund.
Sure.
67% of that fund is invested in 10 stocks, and they're all technology companies.
Wow. Yeah.
And it's a mutual fund. And so I'm sure that mutual fund's talking about a diversification.
Sure.
But I mean, what are we doing here?
Yeah, exactly.
The S&P, you're getting 503 companies.
Yeah.
That's true diversification, because then you're talking about different sectors of the market. You're talking about different, style of investing. You're looking at more of a passive strategy.
But you guys look at everything. I mean, okay, we need, we might have 5% in a precious metal portfolio. We might have 20% in international. We might have, and you're really diversifying. That way, when tech is down, like it was recently, international stocks were up. Right? Precious metals and international were way up here. And even the S&P as a whole, which is driven by some large companies, that was a bit down. So that's what diversification does, is it evens out, so you're constantly making money and not losing, right? That's the key. Or minimizing loss.
Yeah.
So you have to have that plan.
And I'm not picking on tech, by the way. I know it's like we are.
No, I mean, NVIDIA is one of the most successful. Tech's been part of the Magnificent Seven, which has carried the market, but it will have times when it tanks, right? When it's way down. So you need diversification for those times.
Yeah. And so it's really about making sure you have somebody to work with to say, hey, I think in this market environment, I think we're heavy on the tech. I think we should maybe look at some more blue chip company names that pay dividends. So even if those companies aren't growing their stock price, what they're doing is they're paying you for owning them. That's what dividends are. The company is literally paying you as a shareholder to hold their stock. Even if, times are bad and they're not doing anything to increase shareholder value or grow the stock price, you can still get paid, Tony. And everybody likes to get paid, right?
I like to get paid. Yeah. Well, hey, we don't have much time. What else do you have?
No, I think that's the big pieces that I wanted to touch on today. But if there's a topic or something that we've covered, or even something that we didn't cover, Tony, that somebody's listening and says, hey, Andrew, I'd like to sit down and I'd like to talk about this thing that I don't understand, give us a call, 402-557-6730. Come in, visit us here at the Premier Group, and let us talk through some of these things that you don't understand. So
huge. Great show. Great point. Thank you, Andrew. Listeners and viewers, thanks for tuning in. That does it for today's episode of the Big O Money Show with our host today, Andrew Galvin.